So the first session, for the morning sessions, we've focused on international and domestic politics within our industry. Before lunch, we're going to turn our attention to the economic context and to business. We start with Steve Pateman. Steve joined Santander in 2008, becoming Executive Director and Head of UK Banking earlier this year, and is a member of the Santander UK Board. His responsibilities cover retail, corporate, commercial, and business banking. Previously with NatWest and RBS, he has extensive knowledge of corporate banking and specifically the leisure and retail markets. We are delighted that Steve is with us here today, given the current economic crisis facing Europe. So, Steve, we appreciate your time. I'm sure you've got many other issues to attend to at the moment. So please welcome sponsor and supporter Steve Pateman, who is setting the scene for our panel session titled Hurdles, What Hurdles? Steve.
Thank you very much. I have to say that given the events of 2 Fridays ago, which was after Moody's downgraded us by 1 notch, which was reported by the Daily Mail as a shock downgrade and a slashing in our rating, I'm hoping you're going to be a slightly more favourable and easygoing audience than the myriad of journalists and TV commentators I had the pleasure of chatting to for about what seemed like forever, but was, I think, probably 12 continuous hours about 2 weeks ago. So I find myself with the economic slot because I was at a BHA dinner recently where our chief economist was supposed to do the piece on the economy, and he was ill. So I said that I would step in and have a stab at it. And clearly, I either did a good job, which is why I'm kind of having another go today, or I did a really bad job and they're letting me have a sort of second attempt to see if I can get it right. So this is a collection of Barry's slides. Barry Naisbitt is our economist with perhaps a business perspective rather than an economist's perspective. So hopefully it will kind of find the right balance. So here we go. One thing I can say about the next 10 minutes or so is it's not kind of full of good news. I think that trying to put together some slides that would show a particularly optimistic outlook for the economy, whether it's in the UK or Europe, would actually be quite a challenge. So what I'm going to try and do is maybe set some context around what I think will be potentially a slow and very difficult recovery in the UK, a slow and very difficult recovery in Europe. And actually, whilst that doesn't sound particularly attractive, I think compared to the potential downsides, a slow recovery would be a very good outcome over the course of the next 5 to 10 years. So in terms of GDP growth, I mean, clearly this has been in the news fairly recently in terms of the first quarter outturn coming in at minus 0.3%, largely because of a particular slowdown in the construction industry. But for me, from the businesses that I see on a day-to-day basis and from the statistics that I read on a day-to-day basis, the UK economy just seems like it lacks confidence. The consumer lacks confidence. He's very nervous about his future spending power. He's seen his spending power pretty much eroded over the course of the last 4 or 5 years as inflation, inflation on goods has outpaced wage inflation pretty significantly. He feels nervous, particularly if he's in the public sector, about his future. And when people are nervous, they don't tend to spend money. They tend to kind of defer purchases. And then actually you get a very sort of negative economic spiral. And I think what you're seeing in terms of the slow growth here is not so much a reaction to events in Europe, but effectively people being more cautious about where they're going to spend money and how they're going to spend money going forward. And that's kind of contributing to a very slow recovery in terms of output. So we're still sort of tracking at a level below where we were 4 years ago. And actually, we are probably one of the only few countries in the world that are still tracking at a level where we were below where we were 4 years ago. The United States, in comparison, has now passed the level of where it was pre the recession. And in fact, the United States is showing quite a lot of positive signs of recovery. The Eurozone, Japan, and the UK are still tracking below. And clearly within the Eurozone, there's the drag factor of some of the southern Mediterranean economies relative to the stronger performance of the northern economies. Consumer spending in the UK actually has increased in value, but that's pretty much in line with inflation. And actually what's kind of more interesting, and it comes through in some of the footfall statistics that you see, particularly around retailers, is that actually the volume is actually not recovering and is kind of sort of tracking pretty much in a flat line and pretty much for the last year or so. And I think that comes back to the comment I made previously, whereby wage inflation has been pretty low, pretty modest, around about 1 or 2% for the last 2 to 3 years. And actually inflation, as you know, has kind of tracked much closer to 4 or 5%. That takes a lot of spending power out of the economy. It takes a lot of discretionary spending power out of the economy. And if you then add into that the fact that there's a lot of fuel in terms of expenditure in the economy from people taking equity out of their houses, so when they saw their house prices rising, they're able to remortgage, take the equity out. There's a lot of interest-only loans and so on and so forth. That has stopped. And so over the course of the last 2 to 3 years, you've seen house prices clearly have flattened, so therefore the ability to kind of remortgage and take equity out and spend it is not there. Interest-only loans are, frankly, not going to be on offer going forward in the future. So this kind of artificial spending power that fed into the economy is no longer there. And at the same time, you're seeing the cost of basics exceeding the cost of your wages. So you've got a twin pressure on discretionary spending. As I said, this wasn't going to be a particularly fun-filled 10 minutes, so I can see from the enthusiasm in the audience that it's going down really well. But as I said, I may be responsible for a number of things, but I'm certainly not responsible for the economic performance of this country, or indeed anyone in Europe. And what has been happening alongside this? And so alongside the pressure on people's spending capacity, there's been a desire to deleverage. And I think one of the most, I guess, telling slides that I've seen in the last year or so is that when you add up the debt in the United Kingdom, so that's the debt the government has, it's the debt that companies have, it's the debt that you and I have, we are probably one of the most indebted nations in the world. And if you look at the trajectory of debt for virtually every country in the world, they're sort of in this band. There's a band of all the developed countries are sort of down here, and then there was Japan sort of somewhere up here, and nothing in between. And instead, over the course of the last few years, there's been this little red line that sort of wound its way from the developed countries down here, and in the last year has just passed Japan. So we are now the most indebted country in the world when you kind of aggregate government debt, company debt, and individual debt. Excuse me. And that kind of seems quite strange when you see lots of indications about households de-gearing, reducing their credit card spending, not taking out unsecured loans, and so on and so forth. And actually what's been going on is that actually the households have been de-gearing, and companies have also been de-gearing at the same time. But alongside that, there's a huge part of the population which cannot de-gear because they just don't have the free capacity to do so. I think the statistic around the amount of free cash that the average family has in the UK is something like £4 a week now. And actually that doesn't give you very much de-gearing capacity at all. So the combination of some people who are able to de-gear is being offset by lots of people who can't, and actually they're just seeing an increase in their level of debt going up. So what you're actually seeing is pretty much a flattening rather than actually a reduction. So turning to the future, I'm always kind of amused by these sort of economist graphs because actually it clearly tells you nothing. Other than the fact that the future is somewhat uncertain, and I don't think you probably need a graph to tell you that. But these are the sort of graphs that the Bank of England produced to give you a sense of direction as to where they see GDP going forward. So as you see, they've kind of pretty much hedged their bets as to where it might go. Kind of gives them the opportunity to reforecast every 3 months. So, I mean, the reality is, cutting through all that sort of green haze. I think what's going to happen is pretty much what I sort of said at the outset, which is GDP will recover, it will take time, it will be slow, and actually it's probably going to get to sort of an average of about 2%, and that's kind of broadly where the consensus is. I said that doesn't seem attractive when you think of the passage out of previous recessions. The passage out of previous recessions has been you dip down and you come back quite steeply. This is proven to be a recession where you dip down and you come back very slowly. But actually, whilst that doesn't look particularly attractive given where we've the experience we've had in previous recessions, the reality is that the alternatives, if you were in countries like Greece or Italy or Spain or some of the other countries where they had severe austerity measures, is that actually you won't see any recovery at all. So whilst 2% doesn't seem that exciting, actually it's a hell of a lot better than continuing to be pretty much in negative territory, as the combination of all those austerity measures actually really depress the economy in those particular countries. The world, however, as I alluded to, is a very different place depending upon which part of the world you happen to be in. And ironically, I think for the first time that I can remember in many years, the developed countries are struggling much more than the developing countries, with the exception of the United States, which is actually has adopted much more of a sort of spend its way out of recession approach. So the United States, because it's, I guess, the reserve currency of the world, and the Chinese are quite happy to continue to buy their debt, have effectively managed to find a way to kind of spend their way into recovery, whereas most of the approaches taken by European countries, and in particular in the UK, is that we haven't spent our way out of recovery in terms of public sector spending. We've relied on the private sector to kind of spend out their way out of recovery, and I'll touch a little bit later on why the private sector finds it very hard to effectively spend its way out of recovery. But the growth that you're going to see in the world in terms of economies growing is not going to come from Europe. I mean, Germany, I think, will continue to grow, but beyond Germany, there's not going to be very much growth in Europe. We've talked a little bit about the UK. I think the US will be stronger, but the growth is still going to come from China, from India, from Brazil, from Latin America, and actually from Africa. I mean, I think some of the growth that has actually now been achieved in some of the African countries, when you consider that Africa has usually been regarded as something that gets lost between the developed countries and the developing countries, actually the growth that's going to come out of Africa, I think, is going to surprise many people over the course of the next 10 years or so. So here's another one of the economists' sort of charts where they kind of hedge the future, and this is around their view of inflation. So I think most people's expectation, I imagine certainly Mervyn King's expectation, is that we will get back to 2%, and that's kind of where the thickness of that red line is. And I think that will be a function of a continued slowdown, excuse me, in terms of spending in the UK economy, and actually the winding out of some of the imported inflation. But as you've seen with the slightly slower progression towards that 2%, so we've kind of seemed to have stuck around about 3% at the moment, we are still importing a lot of volatility, and we're still importing quite a lot of inflation, and that will continue, particularly as uncertainty continues to reign over the Middle East in terms of Israel and Iran and so on and so forth. But if the economy in the UK is going to recover, if the government is going to deliver on its strategy for economic growth to be driven from the private sector, and the strategy is very much about cutting public spending and letting the private sector drive growth and drive the recovery, then consumer confidence has to pick up. And if consumer confidence doesn't pick up, then this recovery just will not happen. And in the UK, consumer confidence continues to be a problem for us, both in terms of how people feel about the economy and how people feel about the environment in which the economy operates. And clearly there is an increasingly negative news flow coming out of Europe, which is impacting sentiment in the UK. And that's because Europe is by far and away our biggest trading partner, other than the United States, but pretty much most of our trade goes to Europe. I saw a slide the other day which said that the UK's trade, I think, with Brazil was no more in volume terms than Greece's trade with Brazil. So the amount we export to Brazil as a country is equivalent to what Greece export to Brazil as a country. And when you think about the manufacturing capacity of Greece versus the apparent manufacturing in the UK, that's an interesting statistic. And what it tells you is actually a lot of our activity goes to Europe. We're very dependent on Europe. So if there is negative sentiment in Europe, and there's quite frankly a lot of negative sentiment in Europe, the reality is quite hard to see how UK confidence is going to kind of pick up to the level that's going to encourage businesses to start to spend, to start to invest, and to start to grow. And that's pretty much O-level economics in terms of how economies operate. So I thought to try and sort of not have a few slides about the economy would be a kind of good idea. So my specialist subject is banking rather than economics, so I thought I'd have a sort of touch on the banking environment. I mean, clearly banks have to operate in the economic environment in which they find themselves. So as I alluded to at the outset, I spent a lot of time discussing Europe and the outlook for Europe. I also spent a lot of time thinking about the UK economy. And one of the challenges in the UK economy is not the economy itself. I see lots of businesses who would like to borrow, who would like to invest, and who would like to grow. And I see fundamental changes happening in your industry in terms of the mix of businesses. I see fundamental changes happening in retail, manufacturing, and all the industries that we work with. So I don't feel that necessarily the level of optimism or lack of optimism in the economic indicators is necessarily mirrored in what I see on a day-to-day basis. But what the banking industry is struggling to do is to find a way to support that growth and to support that innovation and to support that investment. Now, the general consensus is that's because none of us understand risk anymore, and therefore actually we've become risk averse. I think as an industry we have become more risk averse than we were maybe 5 or 6 years ago, but actually I don't think we had the vaguest idea what risk was 5 or 6 years ago, and therefore actually it would be a good idea to at least recognise that some does exist in terms of the assets and the portfolios that we build. So therefore, I guess compared to where we were in the heydays of 2006 and 2007, we are more risk averse, but that's probably not a bad thing. And the reason why it's not a bad thing is that banks are increasingly being encouraged to have more capital and to have more liquidity. And the only way that we are going to have more capital and have more liquidity is if we accumulate it ourselves. Nobody is going to invest in this industry on its current returns. So the only way for us to create more capital and create more liquidity is to generate recurrent earnings. It's the only option we have. And you can only generate recurrent earnings if actually you're running a book where your revenue exceeds your costs and exceeds your bad and doubtful debts. And for a number of years, revenue has not exceeded costs or bad and doubtful debts, and therefore our ability to generate the capital and liquidity that we're required to keep has been pretty non-existent. Now, whether banks should be required to keep more capital and more liquidity, which is frankly anti-cyclical in some ways, is an interesting question. If you have a political agenda which says we are going to cut public sector spending, we're going to cut public sector jobs, and we expect the private sector to pick up the slack, then the private sector has to have access to investment to allow it to pick up the slack. If at the same time you're saying to your banking industry, we want you to hold more capital, i.e. money you can't lend, we want you to hold more liquidity, i.e. more money you can't lend, then actually you have conflicting priorities. And that's what we have at this moment in time. We have conflicting priorities. Banks have always been fundamental in supporting economic growth. And the regulation that we have does need to protect the economy from some of the excesses we've seen in the past, but it also needs to not inhibit the role of banks in funding growth. And at this moment in time, it is inhibiting the role of banks in funding growth. And politics is perhaps the way to solve the problem. So when business comes to talk to us about what they would like to do and their investment plans and so on and so forth, what do we look at? I mean, what are the things that you should be telling us about your business to get us to invest in your business and get us to invest in your growth? I've been financing hospitality businesses for probably 20 years, probably longer. I've seen lots of changes in the industry. I've watched the pub sector be split from the brewers and then neatly consolidate into lots of very large pub companies. And then I've watched it sort of do the reverse. In my time in the 1990s, I financed a vast number of acquisitions by Granada and then financed a vast number of disposals, roughly the same businesses by the same entity. So I've seen lots of changes in the industry. So what are the things that we as banks should look for when we're assessing propositions? Firstly, affordability rather than value. There is a tendency that actually, if the loan to value is 60% or 65% or whatever the number is, then it's okay. That's fine, providing the underlying revenues in the business can afford to sustain the capital structure. And if I look at every single business that's encountered difficulties in the last 4 or 5 years, the constant theme that comes through in every single one is over-leverage and a capital structure that could not support the earnings-generating capacity of the business. So for me, I never look at loan to value, I look at affordability, i.e. can the debt be serviced and can the debt be repaid? Now that's not completely repaid in 5 years because practically that's ridiculous, but actually repaid over a sensible 25, 30-year trajectory because actually these assets do have a residual value that should be recognised, but fundamentally it has to be about affordability. And affordability is by definition a function of sustainability. So businesses that have short-term gains, do tricks with working capital, a lot of the kind of private equity stuff that we saw in the last 4 or 5 years, that's not sustainable earnings. Sustainable earnings come from having a strong, well-established business position, and that's a function of management, customer service, and a whole bunch of other things. So in terms of the hospitality industry itself, what does the kind of outlook look like? I think this is kind of difficult because clearly this is a very unique year for the UK economy in terms of the Jubilee, the Olympics, the Paralympics, and so on and so forth. So it's kind of quite hard, I think, to look at this year and try and draw extrapolations going forward. But I think, you cannot dispute the fact, I mean, you would know better than I, that the UK hospitality industry is one of the biggest employers in the UK. It's one of the most fundamentally important industries in the UK, and that's why it's one of the first associations that we sought to reach out to when we started to build our corporate, commercial and business banking business at Santander, because we recognise that the hospitality industry in all its shapes and forms is a fundamental part of the UK economy. Now, on the good news, most people expect spending to actually experience real growth in terms of your industry over the next 10 years. Not huge, I mean 3% is not a massive number, but actually in the context of where the GDP is going, actually it's probably 50% higher than the UK economy is going to produce. So actually that's a positive aspect, and it reflects a continued growth in inbound tourism. So clearly there's going to be a much sharper increase in hotel occupancy, particularly around this neck of the woods, I guess, over the course of the next few weeks. But actually, the general view is that occupancy levels will rise from where they have been over the course of the last few years. And a couple of factors behind that, I've just reflected on the fact this is a ridiculous slide because I can't believe that anybody can read all the words on it. So I'll have a kind of stab at explaining what we think are two of the key factors behind this. So the first one is the emergence of the staycation. So in other words, people looking to have short breaks in the UK, spend time in the UK, I don't think it's a function of worrying about whether Greece will be here in the summer or so on and so forth. I just think it's people making lifestyle choices about how they want to spend time with their families. You've got a combination of your natural inbound tourism and more people actually wanting to stay and spend money in the UK at the same time. And I think you touched on this earlier, I wasn't with you, but the increasing importance of China and some of the emerging markets in terms of bringing people to the UK. Now, it's not a big number in the context of the number of visitors that still come from the United States, but nevertheless, it's a rapidly growing number. So to kind of wrap up around the Olympics theme, I thought I'd kind of leave you with a slide as to what does success look like from a banker's perspective. I think one of the most rewarding things for me in my career and for the business that I run is seeing successful businesses. Is seeing people who have a dream and an ambition and aspiration and actually are able to achieve that. And I like nothing better than kind of going along to businesses that I've been involved with and seeing them thrive and be successful and see actually people's entrepreneurial vision turned into reality. So what do I think lies behind success in terms of turning these visions into reality? I think customer service. I was doing a video for you guys before I came in here. And I was asked a question about what did I think was the most important characteristic. And I think customer service, I mean, I spend most of my time on customer service. I read all the executive complaints that we get. I don't think I have time to do much else. And the kind of common theme with the executive complaints we get is people. And it's people not being bothered. And it's people who say they're going to phone back and they don't. People actually saying they'll reply and they don't. People kind of passing people from pillar to post and generally not telling them the truth. And a whole reality thing. So that doesn't really sound like much of an advert for Santander, I know. But and we're not top of the league for these things anymore. But nevertheless, I think it's an interesting thing that I don't see when I go and stay in hotels in Malaysia or the Caribbean. I find that my family and I have a real connection with the staff very, very quickly. They know who we are, they know what we like, they make us feel welcome. There's a warmth that actually sometimes you don't see in the UK. So I think customer service, empathy, connecting with people, great service is actually a challenge for you guys, and certainly it's a challenge for my industry as well. Location. I mean, location is incredibly important. I see lots of proposals, and I kind of flick down and I think to myself, well, who's going to stay there or who's going to go there? And I often tell the story about the fact that I visit lots of places in the UK, I visit Newcastle. I've never had any difficulty in getting a room in Newcastle, but I've never seen a valuation report that says it's oversupplied, particularly when it's put in the case for a new hotel in Newcastle. And yet, everything tells me that Newcastle is perfectly adequately serviced with hotels, because actually, you know, I've spent lots of time in hotels in Newcastle. I don't have any problem getting a room, and they don't appear to be that crowded. And actually, if you kind of run a business in Newcastle, you'll know it's not probably your best performing business. That's not a general, you know, negative on Newcastle, but actually, there's a huge amount of public sector employment in the northeast, and actually that's a huge influence on that economy. So effectively, the location, the competition are actually very, very important, and I think it requires honesty from the guys who are sponsoring the project and the valuers and the people who are involved, that actually not every hotel proposition is going to be a stonking success. You know, I think, you know, we need to be honest in our assessment, and I think, you know, to a degree, you guys need to be honest in your assessment as well. And my final point is management. Yeah, management is fundamentally the difference between success and failure in any business, and I think particularly in yours. I've seen groups of businesses with outstanding management produce outstanding results, and I've seen the same assets with perhaps less good management fail. And I think the combination of a focus on customers, great management, understanding the competitive set and location are the absolute key to sustainability and value. So with those thoughts, I'm happy to kind of take any questions or for you to go to the panel session.
Great, thank you, Steve. Do we have one question from the audience? One question. Michael.
Thanks. As a result of banks lending on unsustainable feasibilities, you've become the largest owner of hotels in the United Kingdom. Yep. What's your medium-term strategy for your ownership of those hotels?
Well, you're probably asking the wrong bank, but on the basis I haven't got any. But my former employer certainly got some. And so I'll try and give you a generic view. The reality is that the corporate world has a very good mechanism for dealing with over-leverage, much better than countries. So, you know, a business has over-leverage, it can't sustain it, the earnings are unsustainable, effectively the business goes into administration or default, whatever you want to call it, and actually somebody else comes in, buys it, injects equity, there's a new capital structure, and actually if it's a good business, it'll kind of move on. If you think about the Channel Tunnel, that's a great example. I mean, that went bust 3 times, but it's a fantastic business now because the new owners haven't really had to pay for the tunnel or anything. So but that's reality, right? So, you know, as at today, it's a fantastic business, but, you know, for the guys who previously owned it, it wasn't such a good thing. So, arguably, that's what's got to happen to these assets. They have got to be taken out of their existing ownership structure. They have got to be put into new ownership structures with serviceable capital structures that allow the businesses to invest in growth, allow them to invest in their infrastructure and fabric and what have you, allow them to do all the things that they would naturally do, and actually allows the economy to grow as a consequence of the fact that they can employ people to do painting and decorating and so on and so forth. It requires the banks to not kick the can down the road and hope that in 3 years or 4 years' time it will be better. It will not. And to address the fact that there is a fundamental flaw in the capital structure and it's better for them and better for the economy to address that today. And oddly, I'm not usually renowned for sort of waving my flag in favour of regulators, but I would say that the FSA's desire for us to recognise the potential losses we have on our books rather than the real losses that we have will act as a stimulus to forcing banks to do that.
Great. Well, I think if everybody can show their appreciation to Steve Pateman.
Can I just quickly try to put right what I think was a misinterpretation of a point that was raised by Steve Pateman? I just want to say that there is evidence that Santander actually doubled its lending book in the Northeast in 2011. And a significant portion of that was actually for hospitality businesses. So please, let's just put that right. I think there was a little misunderstanding there. I know that Steve didn't mean anything against any area in the UK. I can assure you all of that. So let's just get that right.